Hi, this is Calvin here. Welcome to Trade the Markets Like a Pro, a series of webinar education videos. So in this particular module, Module 8, I will share with you our counter-trend trading strategy, building on the foundation of earlier modules like trend identification, support and resistance, as well as reversal candlesticks patterns. So before we start, let's take a look at the disclaimer slides first. Okay, let me hide myself. All right, here we go. So if you recall, there are actually four different kind of market cycle for any particular tradable asset class, four trade types that we could actually implement our trading strategies to take advantage of which particular cycle that the asset is in. Trend continuation, trend termination, support and resistance breaking, and support and resistance holding. So for counter trend trading, it will actually comes under this trend termination cycle. That means IE is to identify a trend that may be ending and look to take a position against the trend. So that actually give out the name of counter trend trading. All right. So in gist, the principles of counter trend trading is actually to capture very short term swing moves, or we call it a mean reversion kind of move after an overextended decline or rally. And also, these short term swing moves tend to be, in terms of duration, it will be very short, from multi days to multi weeks. So we don't actually expect it to last for 1 to 3 months. All right. So basically, there are actually 5 steps to it. Firstly, is to identify the trend, the support and resistance level, spot the overstretch condition within the trending phase via this instrument or via this indicator called Bollinger Band bandwidth, which I covered earlier in my earlier modules, where I share with you what are the key technical indicators that we can implement in all the various respective trading strategy. So later I'll touch on more in details, not to worry. And also the lower time frame stochastic oscillator to look out for oversold or overbought condition. Step 4 is to look out for trigger signals from the lower time frame as well on the kind of reversal candlestick patterns that we need to spot. All right. Then step 5, before we actually pull the trigger, we need to calculate, i.e., whether is it worthwhile for us to take the trade by calculation of the reward risk ratio payoff, and as well as how to actually place a stop loss based on the dynamic price movement of the instrument that we are looking to trade. All right. So basically, just have a quick recap on module 5. What is Bollinger Band? So basically, right, Bollinger Band, it actually measures the difference between the upper band and the lower band. A rising bandwidth represents increasing volatility, we call it the overstretch condition. A falling bandwidth represents decreasing volatility, we call it a squeeze condition. So what we're trying to do over here is that we are now concerning about, for counter trend trading strategy, we are looking for an overstretch condition. All right, so this is what it means. Okay, so very quickly, this is in the module 5. This is what I call Bollinger Bandwidth. This is the calculation of it. I'll flash on the slides for a couple of seconds. All right, so this is a chart of the Aussie dollar. All right, so what it means over here is that, as you could see, at this point in time, I need to detect the expansion. Okay, do you notice that over here, the upper and the lower band starts to open up like an alligator mouth? Okay, so in this open up of this alligator mouth over here, some of us may find it very hard to visualize. So the better way is to actually plot another indicator called bandwidth that measures the distance of the upper band and the lower band. Like what over here is rising. So what it means that at this point in time, this particular downtrend, this 1 hour Aussie dollar is trading in a downtrend. And right now it already hit a spot that where volatility starts to expand. That means, i.e., this particular downtrend here is overstretched as indicated by a rising bandwidth. That means what we could do over here is that we could actually capitalize a mean reversion movement or a counter trend trading strategy on the bullish buyers to actually play a short-term rebound. All right, so this is how Bollinger Band at us or to help us to visualize a potential counter trend trading setup. So this is the first step, but we need to combine together to actually get a proper trading setup strategy, which I'm going to share with you all in this module 8. All right. So now let's go step by step first. Step 1, okay, is to identify the higher time frame trend and key level. Okay, so let's take a look at the daily chart of dollar CAD. Okay, so you could see over here that dollar CAD is actually trading in a downtrend, lower highs, lower low. All right, very clearly it's a downtrend. But this downtrend over here is now coming to a key support level, which is the major swing low of 7th of September 2017, which is close about a 2.5 years low. And why is it a key support? Number one is in terms of duration is being formed 2.5 years ago, and as well as that after this swing low is formed, you take a look at the dramatic price increase of dollar CAD. All right, so we know that hey, there's this key support level that it may stop this downtrend. All right, but when we know a downtrend will end, it's only that it start to break above this major resistance. But meanwhile, before it break up this major resistance, we could actually capitalize or take advantage of a potential short-term rebound if there's any of it. All right. So the next key step is that hey, this downtrend has almost reached a key support. Now, what are the odds of a short-term rebound? Right above this key support of 120.60. Then I need to look at the next step, step 2, in my bullish counter trend trading strategy. Okay, so I switch on, I open up the Bollinger Band with an indicator on the daily chart as well. Is this downtrend overstretch for step 2? Okay, so if you could see here, the Bollinger Bandwidth also start to rise pretty significantly and break above the previous peak in the last couple of weeks. So we could see that hey, this bandwidth here has started to rise and is rising significantly and it start to break above the previous peak very clearly, very obvious in the last few weeks. So we know that hey, this downtrend here has really started to reach what I call overstretch condition, which actually increase the probability of this snapback in price action, or some may call it mean reversion, or some may call it a short-term potential short-term rebound at this 120.60. All right. Since right now we are taking a look at a very short-term trading strategy that going to last a couple of days only, maximum a couple of weeks. So I can't actually pull off the trigger from the daily chart. Why? Because for daily chart, I need to wait for until a day has end for some signals to appear. As you all know that the FX market is actually more or less 24/5 market. That means I need to wait for until if I'm trading in Asia time zone, I'm solely waiting until the end of New York time. That means the next day, following day, that I decide whether there will be a bullish candle. And don't forget, this is a very short-term trading strategy, taking advantage only to last for a couple of days. So by the time if I wait for the end of the day to form that particular bullish element, the price may have already rebounded. All right. So to capitalize this potential short-term rebound, I need to look at the lower time frame chart, which is the 1 hour chart. Okay, so I switch on to the 1 hour chart. This is the 1 hour chart. So very clearly you see a very strong downtrend from here. So this is where it starts to actually stop at the 120.60 level, 1.2060 at the key support. Then I look out for oversold condition on the lower time frame stochastic oscillator, which is over here. So this one I also covered in module 5. What is a stochastic oscillator? You can actually look back at my previous video. I explain much in greater detail on the parameter of the stochastic, why I switch it to 533, and what is oversold, what is overbought condition on the stochastic. And also more importantly, what is a stochastic oscillator and what does it measure? Okay, so basically, in a nutshell, over here, I want to make sure that this stochastic, the 1 hour stochastic has really dipped into the oversold category, the oversold condition. And the next step is I look out for a signal. That means I need to see a signal from the price action on the hourly chart. That means, is there any potential bullish pressure start to come into the price action on the very short term time frame, which is the 1 hour? This way I look out for a bullish reversal candlestick pattern. So you could recall in my earlier module on reversal candlestick pattern, I share with you all various key bullish reversal candlestick pattern that is appear to have a higher significance to dictate potential bullish we call it bullish price movement thereafter. So one of them will be call it the morning star. So this is a very typical morning star configuration, taking into account of three candlestick. Okay, it's like a forming like a V shape. Okay, so after detecting this morning star, what I could see over here is that means we know that on the daily time frame, it's been overstretched on the downside, reaching a key support. Hourly chart shorter term condition is being oversold as indicated by the stochastic oscillator. Then thereafter, there's some indication of bullish pressure coming into the price section on the hourly candle as well. That means we start to see this bullish reversal morning star candlestick pattern on the 1 hour chart. So for the 1 hour chart, this is where we could actually pull off my trigger. That means I will start to look out for entry level, stop loss level, and take profit level, quite the exit level. All right. So let me plot the exit level. So like I said earlier on, this is a strategy that just try to capitalize or to actually take advantage of very short-term rebound in price action that lasting for a couple of days, maximum to a couple of weeks. So immediately I can't actually project or I can't be so aggressive to play all the way up to this around this 1.2350 level, which is this congestion zone here. I will play up to the last swing high. This is the very obvious last swing high, which is 1.2193. All right, because this is not a trend trading strategy, this is a counter trend. Because we know that the trend is still trending on the downside, unless that major descending resistance I draw earlier on the daily chart has been taken out on the upside. Then we say that the trend has indeed reversed. So till now, we do not know whether the trend will reverse or not. Just bring a short-term rebound to the intermediate resistance, which is on the hourly chart at 1.2193. Then from there, we will decide how do I place the stop loss. Okay, like recall in my previous video, in my trend trading setup video, a stop loss is for us to say, hey, we have been wrong in our bullish bias. That means price has started to reverse against our view. We got to get up fast before our losses accumulated to bigger losses. So that's the purpose of a stop loss. So the key thing about stop loss is that I need to understand how do I place a stop loss? Do I place it of certain bits or certain points, ticks below this key support? 10 pips, 20 pips, 30 pips, 50 pips. But I need to be very objective. Okay, how to be objective is I need to understand upon entering into the position or upon taking that trigger, pulling that trigger, what is the current volatility of the dollar CAD in the short-term time frame, which is the 1 hour. So to determine the current volatility, I'll look at the average true range. It's a volatility indicator, which I explained in greater detail in module 5 as well. All right. So to determine the entry, exit, stop loss level. So very quickly, entry, I could place it at the current price of the next candle after the bullish reversal candlestick pattern. Over here, that means I could actually enter at any price, at the market price. Let's say the market price itself is at 1.2090 at the point in time. Okay, so that will be my entry. Then the next key thing is what is my exit? Exit, remember, will be R1 instead of R2, which is the previous congestion zone here because I'm playing a short-term rebound only. Okay, it should be at 121.93. Then the next key thing is what will be my stop loss. So my stop loss will be taking either the low of the reversal candlestick pattern, the bullish reversal candlestick pattern, or the key support level, whichever is lower. Makes sense, right? So we know that at this point in time here, there's this little tail of the candle that is much lower than the key support. So I'll use the lower tail or the low price of this period of this Morningstar bullish reversal candle, which is at 1.2046, minus off a factor of 1.5 times by the current ATR, which is 21 pips, 0.021. It gives us 1.2015. So this will be my stop loss level. That means what it means that if the price action start to come down and hit 120.60, I'll be stay in position because I need to take account of the potential volatility, the current dynamic feature of this dollar CAD that is trading. If we hit immediately 1.2015, which is 1.5 times of the current volatility or the current ATR, this is where I got to get out, which means that there's a high likelihood that price action that starts to break down instead of going within our earlier bullish buyer's view. All right. Then the next step, I got to ask myself, is it worthwhile to take this short-term bullish trading setup? So this is where I will got to calculate the reward risk ratio, all right, as form of the first step of the basis of risk management. Okay, so the expected reward will be the the R1 minus by my entry level, and the expected risk will be my entry level minus of my stop loss. So as indicated over here, the reward risk ratio is getting a decent reward risk ratio that is more than one, that we want. Okay, anything that is less than one is not attractive. That means I'm taking on more risk. It makes sense, right? For every particular trade that I enter on this dollar cat short-term bullish counter trend trading strategy. So if you could detect it in graphical form, this will be my expected reward. This will be my expected risk. Okay, which is slightly more than one, which is still acceptable. All right. Then thereafter, I'll actually pull this trigger because it's more than one. Then once it hit the R1, this is where I get out of position. All right, because this is a very short-term trading strategy. It's not trend following, so I don't play up to R2. Okay, now let me share with you all another example of bullish counter trend. Pardon me, this is bearish counter trend. Okay, bearish counter trend. That means, i.e., I will actually trading against the uptrend, the higher time frame, which is the uptrend. Okay, so for sure, this is a iShares PHLX Philadelphia Semiconductor ETF. Is actually a ETF listed on the New York Stock Exchange in US that comprises of 30 major US semiconductor stocks. So think of it as like an index of key semiconductor stocks listed on the US stock exchange. Stocks in short, which is the name of the ETF. So for sure that from March low, last year March low, 18 March, all the way up to the recent high in somewhere around in early part of this year, around January, February, it actually hit a upper limit of this long-term ascending channel since March 2020 low. So this is what I call the upper limit or the channel resistance. Okay, so it's an uptrend, hit a key major resistance level, which is at 443.97. All right. So once it hit this key resistance level, we got to ask ourselves, hey, is this push up here being overstretched on the upside? And what are the odds of a short-term pullback? Pardon, okay. This is uptrend. Now, uptrend has reached a key resistance level. So what are the odds of a pullback? All right. So over here at this point, okay, let me perhaps second. Okay, let me change this to uptrend instead. All right. So it's save it. Okay. Let me resume the slideshow. All right. So what it means that okay, sorry. Okay, let me recap again. Okay, that means uptrend has reached a key resistance. What are the odds of a pullback? Okay, that means we're looking at it as, is this a overstretch up move since it really hit the key resistance? So what we're going to do is we got to actually look at the Bollinger Bandwidth. Okay, it's the uptrend overstretch. So we know that, hey, this Bollinger Bandwidth here has started to actually inch upwards. All right, inch upwards already. So we know that, hey, at this moment in time here, it's kind of overstretched. And you realize that previously it also started to inch up and hit the upper limit of this ascending channel resistance. And thereafter a pullback, a short-term pullback takes place. So it's almost the same kind of similar observation has been formed on this Bollinger Bandwidth, that we could actually take advantage of this potential overstretch move in this ongoing major uptrend. The trend hasn't reversed yet because the only thing the trend has reversed is got to break below this major support level. all right, on the lower limit of this ascending channel. So till then, we only look at a very short-term pullback in price action, all right, due to this increasing volatility as indicated by the rising bandwidth of this Bollinger Band. The next key thing over here is I want to make sure that in the shorter time frame, the 1 hour time frame of stocks at the key resistance has led the stochastic oscillator to actually hover in the overbought region. All right, that's step 3, which is checklist done. The next checklist will be step 4. I look out for a bearish reversal candlestick pattern, not bullish at this time because I'm looking for a short-term pullback. So I want price action to start to see a bit of selling pressure at the key resistance. So from here, we start to see over here, this is what I call a bearish engulfing pattern. All right. So with that, checklist 4 has already done. So from there, I could actually calculate what is my entry, my stop loss, and my exit. So like I said earlier on, I will only actually play a short-term pullback in price action because I do not know at this point in time has the uptrend, the major uptrend been reversed to the downside yet because the key support has not been broken to down. So I only play up to the intermediate support level, which is the former swing, these two swing highs, and coincide with this short-term ascending trend line support that actually connect the most recent lower higher lows, all right, which confluence at this level here, which is at 426. Okay, then thereafter I will calculate my entry price, which is my current price of the next candle after the bearish reversal candlestick pattern. So let's say the market price at that point in time is 438.50. The stop loss will be taken on the current ATR of the stocks, the 1 hour time frame, whichever is higher, plus by a factor of 1.5 multiplied by the ATR level. So the current ATR level was actually $3.31, so 3.31. I multiply by 1.5. So this I will actually, since I'm looking for a bearish trading setup, so anything that is higher than my key resistance, if the price action goes up, I will actually get out of this bearish setup position. That means saying that they came to us that our bearish view is more or less wrong. All right. So my stop loss will be whichever is higher. So the high of the bearish candlestick is similar with the key resistance. So no change. If the high of this candlestick is higher, I'll take the high of the candlestick, the bearish candlestick pattern. So it will be at 443.97 plus by 1.5 times by 3.31 equals to 448.95. So that will be my stop loss in this short-term uh, bearish counter trend trade. All right, so my exit will be S1. Okay, then from there onwards, I could calculate my reward risk ratio to see whether is it worthwhile to take this trading strategy. So as we recall, we want to have a reward risk ratio of more than 1. Okay, so my expected reward will be my entry minus of the S1 because we are actually looking for a bearish setup. So I will actually choose to sell high and buy back lower in this trading setup. So it's 438.50 minus 426 will be $12.50 per trade. My expected risk will be if price action goes up instead of comes down, I got to get out because very like high chance that the movement or the strategy has really failed us. Okay, our initial strategy of this bearish counter trend strategy. So the stop loss will be the entry price 448.85 minus of the stop loss, which is pardon me, it's the stop loss. Okay, stop loss minus entry will be 448.85 minus of 438.50 to give us $10.35. So the expected reward risk ratio will be getting the reward divided by the risk will be 1.2, which is acceptable, which is more than 1. So in graphical, this is what we see over here. So what we could see in a couple of days' time, it actually went down and hit the S1. So this is where we get up our trade. All right, so remember, we don't play much lower over to this congestion zone here. We call the S2 because this is still a very short-term counter trend strategy because at this point in time, we cannot be 100% sure that the major uptrend has already ended. All right, so let's come towards the end of my module 8 counter trend trading strategy. So have a great day ahead and I see you all next in my next webinar.